Hello everyone, welcome back. My name is Paul Tilley and welcome to the Atlantic Trades Business Certificate. And this is the financial module, TM1040. And today we're looking at topic 2, which involves securing credit. So what I'm going to do is take you through the slides for this, and I'll give some discussion with regards to it. First of all, I just wanted to show you what we're going to be looking at in this section. Okay, we are going to find and evaluate various sources of funds for a business. Where can a business get its money? Distinguish between what's called equity financing and debt financing. We're going to evaluate the various non-bank options for financing, as well as some bank options for financing. We're going to evaluate government funding sources. Then we're going to distinguish between something called business line of credit, short-term financing, and long-term financing. We're also going to look at credit records and how you can ensure that you have a solid credit record. And finally, we're going to take a look at establishing banking relationships. Well, first and foremost, we have to ask ourselves, why is credit so important for small business? Well, you think about it. It costs a lot of money in order to start a business. Even a fairly small business, if you think about furnishing, accommodations, potentially hiring people, all of these factors all cost money. So unless you're independently wealthy, most of us who start a business are going to require some sort of investment by somebody to help us get started. So investors really need to be encouraged to give money to you. Now, do they do it for good reason? Yeah, they want to make money. So you got to be able to convince and provide a solid business case to people to say your business will have the ability to generate and make profit so that it can pay back the investors with interest. Or if the investor wants to be involved in the business, it can certainly generate a good living for them. So it's very important that we worry about credit and getting the right people involved in order to help get your business started. Next, we'll take a look at, where are some of the sources? And I've got this little graphic here, and this little graphic kind of sums up the basic sources of where all the potential places that you can find money. Well, first, we'll start off with personal investments. You can put your own money into it. Obviously, if you have faith in your business, it speaks highly of the amount of faith you have, the more you put in. So it's my business and I'm contributing to it. Sounds so much better when you're going to look for someone to help you, as if to say, it's like saying, no, I'm not interested in putting my own money in it because, I want you to put yours in. Well, it's very difficult to do that. So we really need to be able to convince people to get involved. And one way to prove that they should be involved is you've invested a lot into it. So personal resources are very important. We also think about banks. The natural thought is, can we borrow money from banks? Well, oftentimes banks are going to be asking some difficult questions of you. Will we get our money back? How safe are you? How secure are you? Do you have a track record? These sorts of things. So banks are a good source, but also they're going to ask you some challenging questions. Next, there's something called love money. Now, love money is really money from family. Now, family will have a slightly lower bar. Obviously, they're going to invest, and they obviously want their money back at some point in time. But if they don't get it back quickly, or if they don't get it back at all, they're probably not going to take you to court or to sue you for it. So you think about family as a good resource because there's not as high a commitment to paying it back as soon as possible. Venture capital. Venture capital is a fancy word for people who are high-risk loaners. Venture capitalists are fairly wealthy individuals who look for potential businesses where they could make a lot of money. They're taking on a lot of risk, so the risk-reward relationship is there. They're willing to take on a lot of risk, but they also want a good rate of return. So you're thinking about borrowing money from venture capitalists, for example, they're either going to charge a very high interest rate, or they're going to want an equity position in your business. In other words, they're going to want some degree of ownership, and usually that equity position tends to be fairly high. Similar to venture capitalists, we have something called angel investors, and these are people who are pretty well-off individuals who are just looking to give someone a chance. You have to convince them that you are the chance that they should take, and they will be rewarded for that. So an angel investor is just out there looking for potential, and they probably have some business expertise in and of themselves, and they feel that they're going to recognize an opportunity when they see it. Business incubators is another example of some sources. Now, they may not actually give you money, but they may cut your costs. So, for example, universities and colleges such as this one are very into being business incubators. What they will do is provide low-cost accommodations for a business, or provide some support to the business in terms of administrative services and these sorts of things. So incubators help get a business rolling. Once the business is rolling, the expectation is the business will move on somewhere else. Government funding. A lot of people turn to the government and say, hey, government, can you help me? Well, government, is really taxpayers by any other stretch, and their objective is twofold. First of all, from a government perspective, they want to create economic development. So that's one thing. So they'll look to you as being a potential developer. But on the other hand, they'll also look at you and say, well, this is taxpayers' money we're investing in you. We want some assurance that this money will be well spent and that the probability of us getting it back is quite high. So government really is going to be fairly demanding as well. All of these features all come with benefits and costs, and you should be aware of them. Generally, we can break the type of investor, if we think about those investors, we can break them down into two types. First, those are people or businesses who are interested in loaning you money. They don't want any share of the business. They just are going to provide you with a sum of money. You, in return, promise to pay that money back with interest. So, for example, a bank will loan you money. They will have a repayment schedule for you, and they will charge you a fixed rate of interest. So it's the cost of renting the money is interest. Some banks will have lower interest rates than others, depending on the level of risk that they associate with you. And this is where getting a good credit score is important, because when you have good credit, the risk level drops and your costs of borrowing drop. Now, the other type of investment that a lot of people turn to is something called equity financing. Now, if it's your business, what you're pretty well saying to an equity investor is, I will cut off a share of my business and give to you. In return, you will give me some money with which to grow the business. Now, if you're an entrepreneur and this business is your baby, it might be very challenging for you to give up some of your baby to give to someone else. Businesses need to be aware that when they get equity financing, they are giving up a share of control of their business, and that's a big challenge. Now, the advantage with equity investment is that that equity partner often comes with some degree of expertise that they can bring to the business, some degree of management capability, some degree of resources that they can bring to the business. And they don't necessarily require a payment on a regular schedule, such as a loan would require interest payments. Equity investors are looking in the long term. They tend to look for appreciation, so that they're going to buy at $10 and sell for $20. That's really what they're into. So from an equity point of view, you give up a share of the business, but the advantage is you don't have to pay a fixed interest. The idea is that they're looking for a longer term. When they sell their share, they'll recoup their investment. I want to take a look at was the financing options. Well, depending on the size of the business, you're going to go to a bank and say, I need a lot of money or I need a little bit of money. Banks are going to look at you and say, well, what kind of money do you need? Is it money for materials, inventory, equipment? All of these factors are going to come into play. And depending on what it is, they're going to say, well, okay, I can provide you something called short-term financing, or I can provide you long-term financing. Short-term financing tends to be financing that's scheduled to be repaid back within a year or two. Okay, so this is what we mean by short term. But short-term items include things like inventory. Okay, this is stuff that gets used up, sold, turns into cash on a fairly quick basis. So banks often will provide short-term financing for those sorts of things. One type of short-term financing that we look at is something called a line of credit. A line of credit is a pre-approved loan to a business for or up to an amount of money. And the bank will say, okay, let's say $50,000 is the approved line of credit. The business can draw on that $50,000. And they can draw it and they'll pay it back. As long as it's less than the approved level, the bank doesn't have to review it every time to see if you're creditworthy. Basically, they've given you a cap. They say you can borrow up that amount, pay it back, borrow up that amount, pay it back, borrow. And most businesses like lines of credit, particularly from a short-term financing point of view. Take, for example, most businesses, if they're a seasonal business, they do most of their work in the summer. So revenues come in the summer and fall. They don't do a lot of work in the winter, in the spring. That financing, that short-term financing line of credit, could be very useful in the winter and spring when very little revenue is coming in, but the expenses continue. The other type of financing that is often looked at is long-term financing. Now, what a long-term financing is for long-lived assets, such as buildings, cars, these sorts of things. The idea is that the repayment will be way over a period of many years. So a building, for example, the repayment could be 20, 25 years. A car, 3 to 5 years. So essentially, what this does is the bank will give you money, or the lending institution will give you money that is repaid back over the long term. And it's usually for higher value items that have longer durability. And what the bank will do, or the lending institution will do, will put some sort of lien on that equipment as a guarantee that you'll pay it back. So the equipment that you buy is actually the guarantee that you'll repay it. Because if you don't repay the loan, they'll come and repossess it on you. Banks will look at it, regardless if it's short or long-term financing, and they'll look at you and they say, okay, well, you know, how much interest are we going to charge? And really the amount of interest you're going to charge is really dependent on the borrower. You know, they look at things like, what are your borrowing requirements? How quickly do you need the funds? What type of borrower are you? What type of lender are we? You know, are we a high-risk lender or a low-risk lender? Type of collateral, what type of things can they grab if you don't pay your money? And what's the overall financial health of your business? All those factors go into this magic mix in order to determine what type of interest rate they'll charge you. A higher risk business will cause the lender to charge a higher rate of interest. Lower, a proven track record business will have a lower cost of borrowing. So those are a couple of the key things there with regards to the borrowing type of situation. The really, as we move further, we're going to ask ourselves, well, okay, let's say we can borrow some money. How, or we recognize that we need to borrow some money, how do we ensure that we can get a yes on the loan? Can we get them to say yes? Well, that's really an important thing for many small businesses, and it deals with this securing and establishing credit. So securing financing is really essential to your business. The thing is you have to prove to the lender that you are creditworthy. In other words, you're going to pay it back. They have to have reasonable degree of certainty that you're going to pay it back. So the things that you do as a business and the things that you do as an individual will contribute to that overall assessment. So if you start a business, you want to make sure that you get your bills paid on time, that you pay back your loans as you say you will, that you increase your sales or demonstrate that your sales are building, demonstrate that you have good policies in place for ensuring that your accounts receivables are collected or your receivables are collected, and make sure that your payments are obviously made on time. And there are some options for companies if they feel that they're not overly creditworthy. They can lease equipment as opposed to buy it. They can rent versus buy. They can reduce their overall demand for credit by borrowing or renting or non-ownership, any non-ownership things. So a lot of small business, when they start off, don't own a lot. The reason is you just cannot finance to buy all those sorts of things. There are tax implications to it all too, and usually leasing is more beneficial from the point of view of taxation and writing off the expenses. So, if you're a lender, now let's look at it from the bank's point of view. What are we going to be looking for in order to lend you money? Well, how much money you're going to need is certainly going to come into play. How much collateral you have, what items do you have to secure the loan? House, car, personally, what do you have? What are you going to use it for? Is it going to be a long-lived asset, short-lived asset? Do you have a clear business plan? So this is where business plans come in to kind of sell it to the investor that you have a plan to move forward and pay back loans. Your personal financial statements, how much money do you have to put into it? How much skin in the game do you have? What's your profit and loss statement? So again, your financial statements from the previous number of years is going to be useful in order to help convince lenders that you're worthy of the credit. And cash flow, determining when the dollars are coming in, what times. If you're running a ski hill, for example, the cash flow tends to be during the winter. That's when your revenue comes in. You have very little revenue in the summer. As long as it clearly states that that's when you expect the money in, a lot of the lenders will say, oh yeah, that's when we expect to get paid then. If things do go wrong, and sometimes they do with regards to credit, you need to be aware of what are some of the implications to that. Things can go wrong in credit in one of two ways. First of all, if we look at it, it's when you and your company cannot pay its bills. Okay? So business debt comes into play. The other aspect of things that can go wrong with credit is you provide all kinds of credit customers in the sense that buy now, pay later, and they don't pay later. So two of those things, be it your inability to pay your own bills or customers not paying for things that you've provided, can be a death knell for business. So there you go. There are some of the major pluses and minuses of securing credit. I think that we can't overstate the fact that regardless if it's a positive, you're growing, you need to increase your credit to get new equipment, grow your business, these sorts of things. Or if you're running into problems in the sense you can't collect your debts fast enough to pay your bills and you need some sort of funding in order to get you over this hump. Regardless if it's a positive or a negative problem, building good banking relationships with your banker is important because these things will crop up from now and then. So one of the things that we want to emphasize here is find a banker, build a relationship with that banker, someone you can trust, someone who will work with you. They recognize the value of your business. You recognize the value of them. Work with them in order to resolve problems as you move forward. Building these banking relationships is critical to making that happen. Anyway, that's a summary of this particular topic. If you have any questions, any concerns, any issues, anything that you want to bring up, please let me know. At the end of the unit, there's a discussion problem. I'd like you to answer that. Thanks a lot. I'm Paul Tilley. See you next time.